Friends, in the world of mutual fund industry, a very common pattern is observed among investors. Most investors, instead of building a focused portfolio, end up accumulating too many funds over time. If you closely look at the portfolio of an average retail investor, you will often find that the number of funds is not just 5 or 6, but sometimes even more than 10. Whenever a new fund offer, NFO is launched, they feel excited about it and decide to invest, believing it to be a new opportunity. Similarly, when they see a particular mutual fund delivering very high returns in a specific year, they either start investing in it immediately or start a systematic investment plan, that is SI. Step by step, this habit of chasing new or best performing funds leads to a situation where their portfolio becomes cluttered. Now, what is the problem with this? At first glance, having many funds may give the impression of diversification. But in reality, it creates a serious drawback. Their returns get diluted. When money is spread across too many funds, the ability of the portfolio to generate strong focused returns weakens. But then the question arises, why do investors do this in the first place? The answer lies in human behavior. Investors are always in search of higher and higher returns. Suppose they already hold one fund in their portfolio, but that particular fund is not performing better in comparison to a other fund. At this point, a thought immediately arises in the mind of the investor: why not switch to the fund which is performing better? This constant temptation to capture the next best return fund is what drives them to keep adding funds unstoppably. Another factor that fuels this behavior is the hype created around NFOs launch. Whenever an asset management company launches a new scheme, it is marketed very aggressively, sometimes creating a fear of missing out among investors. Many people get carried away by this excitement and invest in the NFO without deeply analyzing whether it truly fits into their financial plan or not. Over time, these small decisions build up, and before they realize it, their portfolio is already overflowing. Now that we understood that approach is not ideal, the next step is to explore the right way of investing in mutual funds. The most important question every investor should ask to him: how many funds should I have really in my portfolio? And which funds those should be? Key to answering this question is clearly about your financial goals. Unless you are very clear about your financial goals, why you are investing, how far away in the future that goal lies, then you will never be able to decide the right number of funds, the right type of funds, and also the correct risk profile of your portfolio. For example, if you do not know whether your goal is just 3 years away or 20 years away, how will you choose whether to invest in an equity fund or a debt fund or a hybrid fund? Without that clarity, investors simply collect funds at random, and the portfolio loses both focus and effectiveness. This is why, before building a portfolio, one must always start by identifying the exact financial goals. Whether it is buying a house in 7 years, planning for some commitment after 15 years, or preparing for retirement after 25 years. It is equally important to understand that mutual fund investing, especially in equities, is fundamentally a long-term activity. If your financial goals is only 2 or 3 years away, mutual funds are not the right place for your money. For such a short time frame, it is better to avoid the volatility of equity markets altogether and simply put your money into a fixed deposit, which is safer and more predictable. However, if you still want to explore mutual funds for a short-term goal, the right choice could be a debt fund. Debt funds provide moderate returns, usually slightly better than FD, while still offering relative safety. They are not meant for deliver very high growth, but they are useful for preserving capital and giving some additional returns over traditional options. On the other hand, if you are willing to take a bit more risk and want a slightly better return potential, you can go for a hybrid fund. Hybrid funds are designed with a balanced approach. They invest a part of their money in debt instruments and the rest is in equities. This structure ensures that even if the equity market underperforms, the debt allocation provides stability and cushion the overall portfolio. The biggest advantage of hybrid funds is that they protect you from negative returns in most situations. Sometimes that pure equity funds cannot guarantee. At the same time, if the stock market performs strongly, hybrid funds also reward you better compared to the pure debt funds. Of course, the risk is somewhat higher than debt funds, but the potential reward are also greater. So the real lesson here is that mutual fund investing should not be about chasing every new scheme or collecting funds randomly. It should be about clarity, discipline, and alignment with your goals. A cluttered portfolio with too many funds only weakens performance, while a carefully chosen, focused portfolio built around your financial goals and time horizon creates the real wealth building opportunities. So, if your time horizon is between 3 to 7 years, then in that case, you have to invest in flexi cap funds and also make one investment in mid cap fund. You can keep two funds here. The reason for having two funds is that the mid cap fund will give you aggressive growth and the potential for a strong return. At the same time, whenever you redeem after 3 or 7 years, the flexi cap fund will protect you from market volatility, which will allow you to stay invested in the market for the entire 7-year period. But why is this important? Because normally investors get scared by the ups and downs of market volatility and end up redeeming their investments before they achieve their goal or even before their time horizon is completed. They fear that if the market continues to fall, they could face a huge loss. But generally, if you have invested in a flexi cap fund or a mid cap fund and your time horizon is up to 7 years, the likelihood of getting negative returns after 7 years is very low. On the contrary, there is a very good possibility that you will also get strong returns, provided the market remains in a reasonably good condition. However, if your time horizon is between 7 to 10 years, then you need to be a little more aggressive. Because when you stay invested in the market for such a long period, you naturally expect to earn higher returns. For this, you should continue holding the flexi cap fund and the mid cap fund as well. But in addition, you should also add a small cap fund to your portfolio. In this way, you can hold up to 3 funds in your portfolio. The allocation among these funds should be equal so that you maintain a good balance between volatility and returns. However, if your time frame is long enough, that is 10 years and above, then you can afford to be even more aggressive. But even here, you should limit yourself to only 3 funds: one flexi cap fund, one mid cap fund, and one small cap fund. The reason for this is psychological support. Because if you invest all your money only in small cap funds, thinking that since your time horizon is more than 10 years, then you may face challenges. While that approach addresses the returns aspect, it does not take care of the psychological aspect. If your volatility tolerance is low, then staying invested in a pure small cap portfolio will be very difficult to you. When markets fall, small cap funds typically fall even more. For example, during COVID, when the overall market fell by around 30 to 35%, many small cap funds dropped by 50 to 60%. Experiencing such a sharp downturn in your portfolio makes it very hard to remain invested for a common investor. That said, it is also true that for experienced investor, that period was actually the best time to invest. Those who continued their SIPs, did not stop their investments, and avoided redemption today enjoying portfolios that have delivered excellent returns. The drawdown has been fully recovered, and beyond that, they have earned manifold returns in absolute terms. So, even in the long term horizon, it is better to keep all 3 types of funds: one flexi cap fund, one mid cap fund, and one small cap fund. However, here the allocation should change. Instead of equal distribution that work for 7 to 10 years horizon, you should now allocate about 20% to flexi cap, 30% to mid cap, and the remaining 50% to the small cap. This way, you position yourself for a aggressive growth. And after 10 years, the probability of achieving very strong returns is very high. Now, this was about how many funds you should keep in your portfolio. But how do you select those funds? Because in every category, you will find many options. The right way to choose is by looking at the fund's performance. For this, you should consider a 5-year performance period. A 1 year, 2 year, or 3 year performance period is too short, while 7 years or 10-year time frame is too long. By evaluating 5-year performance, you can make a fair assessment of how the fund has been performing and what its potential for future performance looks like. That said, you should not simply pick the fund that ranks Number one. Instead, also look at its performance across over other time frames, that is 1 year, 3 year, 10 years. Although your primary deciding factor still will be the 5-year performance. For example, suppose a fund ranks 4th in 1 year performance but has been very strong over 10 years and also ranks among the top 3 over 5 years. As a rule of thumb, such a fund can be considered a good choice. Similarly, if a fund ranks within the top 3 in its category over 5 years, then you can also consider investing in it, providing it aligns with your preferences. Here the meaning of preferences is what you prefer, a fund that follows a growth investment strategy or a fund that follows a value investment strategy. So along with performance, you should also pay attention to the fund's investment strategy, whether it follows a high growth approach or a more defensive value investment approach. Generally, funds following a value investment strategy deliver lower volatility, but also their long-term returns are often not as strong as of a growth-oriented fund. This is where you also need to consider your own psychology. That is, if you cannot handle too much volatility, then you may be more comfortable with a fund that follows a defensive value investment strategy. On the other hand, if you want higher returns and can endure volatility, then fund growth strategies are better suited for you. However, if your portfolio and time horizon is 10 years or longer, then you can definitely choose funds that follow an aggressive growth strategy. But you must prepare mentally for the ups and downs. These funds may experience significant volatility in their NAV, but in the long run, they tend to deliver superior returns as well.